let's talk about something that might sound a little bit crazy. What if I told you that the very investments you believe are keeping your money safe are actually the things making you poorer over time? Yeah, let's get into it. I want you to really think about this for a second. You look at your bank account, you see the balance, right? It feels secure. It even goes up a tiny bit with interest. But what if that's an illusion? What if, in terms of what that money can actually buy you, that number is shrinking every single day?
This quote just nails it. The financial advice our parents' generation lived by was probably great advice for them, but the game has completely changed. Sticking to that old playbook today, well, it's a guaranteed way to fall behind.
So let's be fair and first talk about the old rules. The advice we all grew up with. There's a real, genuine comfort in seeing a steady bank balance or holding a physical piece of gold. It feels real, it feels secure, it feels simple. But there's a catch.
See, that feeling of safety, it's not free. It comes at a cost. A hidden cost, really. It's like a silent tax that most of us don't even see happening until it's way too late. And it's paid to this relentless force that's always working against your savings.
And that force, of course, is inflation. The best way to think about it is like a silent thief who just sneaks into your bank account year after year and steals a little bit of its power. So let's break down exactly how this villain works.
Okay, in the simplest terms I can put it, inflation just means your money buys you less stuff tomorrow than it does today. It's why a cup of coffee that cost $1 10 years ago might cost you $3 now. Your dollar just doesn't go as far.
This right here is one of the most important concepts to get. It's the difference between what you think you're making and what you're actually making. The bank might advertise a pretty good-looking 5% return. That's the nominal return. But if inflation is running at 4%, your actual purchasing power only went up by 1%. That's your real return. And honestly, it's the only one that matters. And this quote just brilliantly paints the picture. You think you're getting ahead, but you're really just on a financial treadmill, running in place. And that's before taxes. Once you pay taxes on that tiny 1% gain, you're almost certainly losing ground. You're getting poorer while thinking you're doing the responsible thing. It's crazy. Okay, talk is cheap. Let's look at the cold, hard numbers. We're going to run a little experiment here. Let's hop in a time machine, go back 20 years, and see what really would have happened to our money. So imagine you had $10,000 cash. You could stick it in a safe bank deposit, buy some safe gold, or you could have put it into a simple stock market index fund. What's your bet? Where would you be today?
And the results are, well, they're staggering. I mean, look at this. It's not even a competition. The bank deposit barely kept its head above water. Gold, sure, it did better, but the stock market index fund, it absolutely towers over them. Historically, owning a piece of the actual economy just crushes hoarding cash or shiny metal.
You know what? Forget the charts for a second. Just think about this yourself. How much did a gallon of milk or a loaf of bread cost 10 years ago compared to today? It's probably shot up, right? Now, compare that price hike to the tiny interest rate your savings account gave you. The math is pretty sobering.
So, if the numbers are so crystal clear, why do so many of us still cling to these things that don't work? Well, the answer isn't in a spreadsheet. It's in our own psychology. Our brains are basically wired to choose comfort, even if it hurts us long term.
We're just drawn to stuff we can see and touch. A gold coin feels real. A number on a screen representing a stock, that feels abstract. You add that to what our parents always told us, plus a healthy fear of the stock market's daily roller coaster, and it's easy to see why we get stuck in this low-return mindset. So this is the really crucial part. We have to fundamentally change how we think about money. It's not just about protecting it from being lost, it's about making it grow. We gotta switch from playing defense with our money to playing offense.
And this comparison says it all. The saver is driven by fear. Their whole goal is don't lose money. The investor, on the other hand, is driven by opportunity. They want to grow their purchasing power. One mindset hoards money, the other puts it to work. If you want to build real wealth, you have to adopt that investor mindset. This just says it all. The world of 1980, with its high interest rates, is gone. It's never coming back. We live in a new world now, and using an old map is just going to get you lost. Making this shift from saver to investor, it's not just a good idea. For most of us, it's the only way we'll ever be able to comfortably retire. Okay, so we've identified the problem. We know we need to change our thinking. Now, what's the actual solution?
How do you actually put your money to work and beat that silent thief of inflation?
This is the core principle. It's everything. You have to own things that do something, things that produce value, that generate revenue. See, money that's just sitting still is losing value. Money invested in productive assets, it grows.
So here it is, the new playbook. A simple 3-step plan. First, you build your foundation. That's your emergency fund. 3 to 6 months of living expenses sitting in a high-yield savings account where it's safe. That is the only big pile of cash you should have. Step 2, figure out your goals. Why are you investing? Retirement in 30 years? A house in 5? That's going to determine your strategy. And finally, step 3, with that foundation secure, you invest the rest. You put your capital to work. So what are these productive assets? It's not as complicated as it sounds. We're talking about things like stock market index funds, which are amazing because you get to own a tiny piece of hundreds of companies all at once. These are real businesses selling real products, or it could be real estate that people pay you rent to live in. See the theme? These are assets that work for you 24/7. Let this be your new mantra. Cash, beyond that emergency fund, is a melting ice cube. And gold, it's a hedge. It's a defensive play. It might protect you, but it's not a growth engine. It doesn't produce anything. It's a rock. It won't build your wealth. And that brings us to the final question I have for you today. When you look back 20 years from now, are you going to see a pile of cash that's been eaten away by inflation, or are you going to see a portfolio of assets that has grown, worked for you, and actually secured your future? The choice really does start now.